When it comes to taxes, the word audit strikes fear into many taxpayers' hearts. The process of being audited by the IRS can be time-consuming, stressful, and potentially costly. However, understanding what auditors look for during an audit can help you avoid common pitfalls and ensure that your tax returns are in good standing. IRS auditors use specific criteria to identify discrepancies, errors, and red flags in tax returns, which could trigger an audit. In this video, we'll explore the top 10 things IRS auditors look for first to help you stay ahead of the game and avoid costly mistakes. 1. Unreported income. One of the first things IRS auditors check is whether all of your income has been reported. The IRS receives copies of various forms that report your income, such as W-2s from employers and 1099s from contractors, investment income, and other sources. If the income reported on your tax return doesn't match the income reported to the IRS, it raises a red flag. Common unreported income includes side jobs, freelance work, cash payments, and rental income. Ensure that you report all your income accurately, including less obvious sources, to avoid any issues with the IRS. 2. Discrepancies between business and personal expenses. For self-employed individuals and small business owners, there is a clear distinction between business and personal expenses. IRS auditors look closely at whether you've mixed these two categories. If you've claimed personal expenses as business deductions, such as meals, travel, or home office costs that don't meet IRS requirements, it could trigger an audit. To prevent this, maintain accurate records and ensure that your business expenses are legitimate and only claim expenses that are directly related to your business activities. 3. Large deductions relative to income. Claiming large deductions relative to your income is another red flag that can draw the attention of IRS auditors. While it's perfectly acceptable to claim deductions, such as for mortgage interest, medical expenses, or charitable donations, claiming deductions that significantly exceed your income might look suspicious. For example, if your income is $30,000 and you're claiming $25,000 in deductions, auditors will likely question whether these deductions are legitimate. Make sure your deductions are in proportion to your income and that you have supporting documentation to back them up. 4. Claiming home office deductions. The home office deduction is one of the most commonly audited areas. While it's available to self-employed individuals and business owners, it can be challenging to qualify for it. The IRS only allows home office deductions if you use a specific area of your home regularly and exclusively for business purposes. Auditors will look for signs that your claimed home office is not actually used for business, such as mixing personal and professional activities in the same space. To avoid issues, ensure that your home office meets IRS requirements and keep detailed records. 5. Claiming 100% business use of a vehicle. If you claim a vehicle is being used 100% for business, expect IRS auditors to take a close look. The IRS allows vehicle deductions based on the percentage of business use, but claiming 100% business use for a vehicle that you also use for personal purposes is a major red flag. Auditors will want to see evidence of how the vehicle is used for business, such as a mileage log and supporting documentation. To avoid complications, be honest about the percentage of business use and keep accurate records of all your trips. 6. High income or large refunds. Taxpayers with high incomes or large refunds often attract the attention of IRS auditors. For high-income earners, the IRS may scrutinize whether all income has been reported and whether deductions, credits, and exemptions are being claimed correctly. Similarly, taxpayers requesting unusually large refunds compared to their income may face increased scrutiny. While there's nothing wrong with claiming refunds, make sure that all aspects of your return, including credits and deductions, are legitimate and well documented. 7. Round numbers. IRS auditors often look for round numbers on tax returns, such as claiming $500 in charitable donations or $1,000 in business expenses. While these numbers may seem innocuous, they can raise questions because they often appear to be estimated rather than precise. Auditors prefer to see specific figures, especially when it comes to expenses and deductions. When reporting expenses, try to avoid rounding numbers and provide the exact amounts, backed by receipts or documentation. 8. Claiming losses year after year. If you consistently report business losses year after year, this can be a red flag for auditors. While some businesses may struggle in the early years, repeated losses can indicate that your business is not operating as a legitimate profit-making enterprise. The IRS may suspect that you are claiming the business as a tax shelter to offset other income, which is not allowed. Keep in mind that to claim business losses, you must be able to demonstrate that your business is working toward profitability. If your business is not making a profit after several years, you may need to reassess your tax strategy. 9. Excessive charitable contributions. While charitable contributions are generally deductible, excessive or unusually large donations relative to your income can attract IRS attention. If you claim a large portion of your income as charitable donations, auditors may request documentation and appraisals of the donated items. Be sure to keep records of all donations, including receipts, letters of acknowledgement from charities, and appraisals for high-value donations. While charitable giving is admirable, it's essential to claim donations within reasonable limits based on your income. 10. Failure to report foreign income or assets. With the increasing focus on global financial transparency, IRS auditors are paying closer attention to taxpayers with foreign income or assets. If you have income from overseas or own foreign bank accounts, investments, or property, you are required to report this information on your tax return. Failing to do so can lead to penalties, interest, and potential audits. Ensure that you report any foreign income and assets accurately, including filing the necessary forms, such as the Foreign Bank Account Report, FBAR, to avoid triggering an audit. While IRS audits can be intimidating, understanding what auditors are looking for can help you avoid common mistakes and reduce the chances of being audited in the first place. By accurately reporting your income, keeping detailed records of your deductions and expenses, and following IRS guidelines, you can ensure that your tax returns are in good standing. Remember, auditors are primarily looking for discrepancies, errors, and red flags that suggest potential fraud or misreporting. By being honest, thorough, and organized, you can minimize the risk of an audit and avoid costly penalties.